Thank you very much for joining us today. We're hoping to touch on some ideas and themes as to why Blue Sky's approach to investing is quite different. We certainly hope to at least leave you with some reasons why you should be talking to your advisor about how our funds can become a bit of a portfolio shock absorber. Of course, there's an obligatory disclaimer here, and we're not suggesting you run out tomorrow and invest money in any of the ideas we talk about. It's just to give you some context around what we do. Firstly, let's touch on who's actually investing in alternatives. We've seen that institutional investors have been early adopters. The Harvard Endowment Fund, one of the oldest and largest endowment funds in the world, has over 50% in alternatives. Our own future fund now is running at 30%. Flowing from that, we're seeing Australian researchers now recommending even higher allocations to their advisors and their clients, averaging between 20 and 30% depending on risk profiles. Now, certainly Australia's been late to that party, but we're seeing a lot of acceleration into the acceptance of alternatives. In fact, they're pretty much becoming mainstream. We really feel that people are looking for a reasoned approach that accepts that markets don't always go up. With this in mind, David, we might delve a little bit more into your philosophical approach to investing and how you've been able to generate those returns now over the last 7 years quite consistently. We might just dive in now and have you talk about your approach to investing and what assets you can actually invest in to produce those returns.
Sure. So philosophically, our view is that over the long term, markets are governed by economic fundamentals, whereas over the short to medium term, markets are driven, or market price is driven by flow, liquidity, and largely crowd psychology. So often you get this glaring mismatch between the short-term expectations embedded in psychology, in market price, against the long-term fundamentals. So it's that type of opportunity where the market rebalances or wakes up to where it should be priced as per fundamentals. And typically those opportunities are 6 months to 3 years in nature, and they're across 4 different asset classes. So the fund can invest across currencies, commodities, equities, and fixed income without a long or short bias. So we can look for opportunities where markets are significantly overvalued relative to fundamentals, or opportunities where markets are significantly undervalued relative to fundamentals across those 4 asset classes with a global mandate. So there's usually ample opportunity in any given year for the fund to profit.
So you've got a theme-based approach, David, but it's quite flexible. Can you give us a few ideas on how you actually transition those signals and thoughts into themes, and then how you execute on those to produce your results?
So our process is 3 parts. There's idea generation, there's execution, and then there's risk management. All 3 parts of the process are equally important. If you don't have a good idea, you're not going to make money. If you don't execute your good ideas well, you're not going to make money. And if you don't have good risk management, well, clearly the other 2 parts of the process aren't going to work. So we treat each part of our process independently and equally as important as the other. So once we've developed our macro thesis and it's been well researched and scrutinised internally, we then move it into an execution process which is independent of that idea generation phase of the process. And the reason it's independent is because quite often the person that comes up with an idea has a strong bias toward wanting that idea to be right. So by having an execution process that's independent of the idea generation part of the process, it removes that confirmation bias. So we then move, once we have the idea, we move it into the execution process, which is very much a rules-based process run by different people in the team, and they're waiting for price inflection points. So the price in markets often is a reflection of the psychology underpinning the market. So when we get certain price signals or price patterns exist in a market, then that gives us entry signal to start participating in a particular idea. Often we may have an idea that can sit in execution without actually being implemented for days, weeks or months because we get no entry signal. And by the very nature of running a macro process, often a macro idea can be 18 months early. So it's good to have a process, an execution process that doesn't force that idea onto the market, rather it waits for the market to give you the signal, and you're able to then capture the volatility that the market provides.
Finally, David, you've just mentioned volatility, and it's a word that people traditionally have attached to hedge funds. But the reality is, traditional assets are significantly more volatile. Assets like shares have had months as bad as -50, yet your fund's worth month in 7 years has been -5. How do you manage to keep your drawdown so low?
So we view risk as a function of drawdown or a function of impairment of investors' capital. So the way we invest is we're looking for low risk ways to express a medium-term macro theme. So if the market starts to move against us, we cut our losses very quickly and to keep our losses small. But when the market moves in line with our thematic, we let our profits run. So in terms of how our numbers turn up for our investors, there's a positive skew in terms of the distribution of returns. So we have a lot more larger positive months and a smaller number of smaller negative months in terms of our return distribution. It just means that we can manage the depth of our drawdowns for the portfolio consistently over time, and when we get our ideas running and our themes start to play, that's when we make upsize or outsized returns for our investors.
Look, thanks David for joining us today. I think a lot of investors would like to hear more about your process, and the best ways to do that is to visit the website, give us a call direct, or make contact with your advisor and work through how it can be used in your portfolios.